Welcome everyone. Thank you for joining PKF Mueller for today's webinar, Do You Qualify for the Employee Retention Credit? Before we officially get started with the presentation this afternoon, I just want to go over a couple housekeeping items. This webinar is being recorded and you will receive a copy of the recording along with the presentation slides following the conclusion of the presentation. If you have any questions during the presentation, please feel free to put them in the chat box. We will have a short question and answer portion at the end where questions asked throughout the presentation will be addressed. Now, without further ado, I'm going to turn things over to Mark Stricker to get started.
Hello, everyone. Thank you for jumping on our webinar today. I wanted to first start off of talking about the ERC. We call it ERC for short. And this is one of the fun things that have come out of the whole coronavirus pandemic that Congress put together. And it's actually basically free money. It's similar to PPP. I think most people know what the Paycheck Protection Loan was. Everybody got money. I assume everyone on the call received some funds from that. This is similar to that, but it's not as well publicized. So that's hopefully why you're all here today, to learn more about it. So if you can go to the next slide, please. So the credits is for quarters beginning second quarter 2020 through third quarter of 21. And it's basically $5,000 per employee for 2020. And then $7,000 per quarter for 2021. And there's a calculation, and we'll get into the details of the calculation, but just kind of big picture, that's what we're talking about here. So, if you qualify, it's basically free money. And depending on your state, it's tax-free for your state. Unfortunately, it is taxable to the IRS, but still basically free money. So if you qualify, it's still well worth pursuing. All right, can we go to the next slide?
Yeah, and Mark, just to add on to that, $5,000 per employee for 2020, and then $7,000 per employee per quarter for 2021. You can get $26,000 per employee in total if you were in full qualification. So there's a lot of money out there with this credit.
Right. Yeah, it's for us. We're just having a ball with it because it's one of the few times you can talk to your clients about taxes, and you're basically just finding free money. So. It's been good. Okay, and then so ways to qualify. Basically 3 ways you can qualify. One is the easiest way to qualify is the reduction of your gross receipts. So basically, if your revenue dropped a certain percentage within 2020 compared to 2019, or between 2021 and 2019, basically they're looking at your receipts before the pandemic versus afterwards. And as long as you hit the certain thresholds for each, depending on the year, then you qualify. If you don't qualify on gross receipts, you can still potentially qualify for the government shutdown period. So if you're a school and the kids couldn't come in and everyone had to switch to remote learning, that's a good situation of a government shutdown. So the wages you pay during that government shutdown period could qualify. It's not the whole quarter, but it's whatever period during the actual shutdown you could potentially qualify. And then the third way to qualify is if you were a brand new business that started after February 15th of 2020 and you had revenue of less than $1 million. So they still try to do something. So if you had bad timing and you started your business right during the pandemic, there's still a provision for you where you could potentially get some of this ERC money. So that's pretty much what we're talking about today. And then Dan's going to take over and go through more of the details on how the calculation works.
Yeah, thanks, Mark. Yeah, we've been working on the ERC for mainly we started picking it up starting closer to the beginning of 2021 when they revised the CARES Act to now include, originally it was either you could get a PPP loan or you could get the employee retention credit. And in December of 2020, they said, okay, you can get both of them now. And not only that, but it's also extended into 2021 with the extension of the PPP as well. So it has been, yeah, in the last year, it has been very crazy, and we're excited to, share all this information with our clients about, all the money that is there to be still had, even if you did get a PPP loan. And there's a couple things that I did want to add as far as the initial testing goes for the employee retention credit. One thing I wanted to touch on was the alternative quarter method, which is basically what you're doing is you're comparing your gross receipts to your base year of 2019. So you're taking your first quarter of 2020 and you're comparing to your first quarter of 2019 and so on and so forth. And what happens is in 2020, they have a rule where if you hit a 50% drop in your gross receipts, you get to continue claiming the credit for each quarter until your gross receipts get above 80% of what they were in the 2019 period. So if you had second quarter decrease of 2020 compared to 2019 of over 50%, and then in the third quarter of 2020 you were up from where you were in 2019, you can still take the credit until the end of the third quarter. And so I like to call that you get one, you get two, because if you qualify for one quarter, then you usually get the next quarter, and that flows into 2021, although it's different, using the alternative quarter method, which is basically saying you can use the prior quarter compared to 2019 to qualify you for the current quarter. And so what that means is, let's say you have a drop of gross receipts, you meet the qualification for the second quarter of 2021 in comparison to 2019. You can also take the third quarter even if you were up again, because you could say, hey, we're going to take second quarter's gross receipts and we're going to use that to qualify us for the third quarter of 2021. It can get a little confusing, but essentially, if you get one quarter qualification, in most cases you will get the next quarter as well. And so that's just something that I wanted to elaborate on a little bit. And you're always using 2019 as your base year. So if you're comparing 2020, you're comparing it to 2019, and same with 2021, you're comparing it to 2019. So now that we kind of talked about the testing, I wanted to get into the specifics of actually calculating the credit. And there's kind of three main points that I want to touch on that are involved in this. I want to talk about the full-time equivalents. I want to talk about qualified wages and what they are and how they're utilized for the calculation of the credit. And then I want to talk about some limitations that are on the credit. So what is a full-time employee? And what they want you to do for the employee retention credit is calculate out how many full-time equivalents you had in 2019 to determine whether you are a large employer or a small employer. And if you're a small employer, then you can take your wages for essentially everybody, besides a few, there are a few exceptions to that, which I'll get into, but for the most part, you can take the credit for, you could qualify people's wages, even if they're part-time, if they're full-time, for everybody. If you're considered a large employer, then you essentially are only able to take the credit for those employees who were paid to basically not work, essentially. You were still paying your employees, but they were sitting at home watching TV and not actually able to go into the office to do their job, or they don't have the capabilities to work remotely. So those are the people you can take the credit for, which does limit it very severely. And so I kind of want to get into how you determine that, because that like I said, that can make a big difference on how much credit you're actually going to get. And so basically what a full-time equivalent is for ERC purposes, which is different from the PPP. I know some people probably are thinking FTE from when they were filing for their PPP forgiveness. But it's calculated a little bit differently. And basically it's anybody in 2019 who worked at least 30 hours per week or 130 hours in a month. So you're basically going to do a calculation of what your average amount was, whichever one of your employees were working over 30 hours per week or over 130 hours in a month, and you're going to average that out to see what were your total FTEs. And so for 2020, if you had less than 100 FTEs, then you're considered a small employer. So you can get, like I said before, you can get it for everybody, with a few exceptions, instead of just the people who were only still getting paid to not who weren't able to, fulfill their job duties, essentially. And then for 2021, they changed that. And so they said, instead of 100 FTEs, if you're less than 500 FTEs, you qualify as a small employer. So as you can see, 2021, not only do you get more credit, you get $7,000 per person per quarter, but you also you can have more employees essentially too without being considered a large employer. So 2021 is where the focus of most people is, or where kind of the bread and butter of the credit comes in. And so after you figure out what your FTEs are, you're going to figure out what your qualified wages are. And so qualified wages are, the wages that you have basically paid to any W-2 employee. So if you have employees that are 1099 contractors, that you're not withholding taxes on, and you're not reporting on a 941 form, if you're not filing your payroll tax returns with this person's wages included on it, then their wages aren't going to count for this. And then you can also, and the amount of qualified wages is capped at $10,000 per employee per quarter. And how we figured that out is essentially we say $5,000 is the total credit you can get for 2021 or for 2020, and $7,000 per quarter for 2021. It's just percentages of the cap of $10,000. So in 2020 they say 50% of $10,000. In 2021 that changes to 70% of $10,000, which equals the $7,000. So anybody who's getting paid more than $10,000 of W-2 wages in a quarter is going to get the max amount of credit that you can for that employee. So it's important to figure out what you can include in those wages and what your wages are per quarter. You can also in this include any qualified healthcare expenses and some 401k expenses. If you have, there's certain qualifications for those. I won't go into too many details on that, but basically pre-tax health plan expenses with some exceptions, and some pre-tax 401k. Deductions for employees and the employer piece can be included in the qualified wages for each person. So if I had a pre-tax health plan that qualified, and the employee has $200 a month that's out, we include that in their wages. And then also if the employer has a match of a certain amount, or they pay an amount to their insurance for them as well, we can include that per person on a per employee basis. Excuse me. Okay, and so that's essentially what qualified wages are. And like I said, if you are a small employer, you can include most people, but there are some exceptions to that, and the main exception is owners. If you have greater than 50% ownership, then your wages are not going to qualify as qualified wages. You have to take those out and not include them as far as the employee retention credit is concerned. And this also includes family members as well. So if it's if a woman owns a business and she owns 80% of it, and then her son works for the company as well, then his wages will not qualify as well as hers. So that's just something to keep in mind too. This is one of the things that kind of stinks, just because this credit was made to assist small businesses. And there's so many small businesses that are family-owned businesses that, most of the people are, all the ownership is family, and a lot of the employees are family. And so in these cases, it can kind of, it severely limits the credit. But it's just, that is what the rules are for this. I think they kind of messed up when they originally made this, and they never did anything to change it. So, But yeah, that is something to look out for when you're thinking about whether you qualify or not. Because if it's just you and you're the 100% owner, and you maybe have 1 or 2 employees, but they're family, then it's not necessarily worth looking into, because you're probably not going to get much credit. Okay, let me go to my next slide here. And so I want to talk about some limitations here. And I want to kind of touch on just a few different things here. One of the things we mentioned before is that, you can get this credit even if you did get a PPP loan. So don't think just because you got a PPP loan, you can't still, claim the employee retention credit. But there is some limitations to it, or there is some rules to it. And the main thing is that they don't want you, what's essentially double dipping between the 2 credits. They don't want you taking free government money through the PPP loan and then also using that PPP money to claim a wage credit. So which makes sense. It is pretty logical that they don't want you to use free money to get even more free money. But the good thing about that is that especially in 2020, a lot of people weren't expecting the 24-week covered period to come out. Originally, it was an 8-week period where you had to spend all the money on payroll, but over a 24-week period, most people probably doubled or tripled their payroll in that time period. So if you do have an overlap between the employee retention credit qualification and the PPP qualification, any excess amount of PPP funds you still had, you could, or any excess payroll you had above that PPP loan amount, you can use to claim the employee retention credit. So if you had a loan for a PPP loan for $200,000 over your covered period of 24 weeks, and that was also the same time that you qualify for the employee retention credit, and you had $500,000 worth of payroll, you have that excess $300,000 of payroll that you can use to claim the employee retention credit. So you can still get a good amount, and many times we've seen it doesn't even really come into play too much as far as the PPP. I mean, you take those pieces out and you make sure that there is no overlap, but a lot of times there isn't too much. So you could still maximize every employee that you can while still, having a PPP loan and not having to, break the rules of any of that. The other 2 things I want to talk about, I just talking about PPP loan and how that kind of interplays with it. There is some other credits that are treated somewhat similarly. They're mainly wage credits of, if you're using, the qualified sick leave credit or the family leave wages, the FFCRA credit, it's treated kind of the same way as the PPP, where they're like, you're going to get free money from these credits, and we don't want you using that to get more free money with the employee retention credit. So if you were already paying people's sick leave and recording on your 941s the family leave wages and everything, they don't want you to overlap between that. You're going to have to take those wages used out of the equation when you're thinking about the ERC. In 2021, they kind of increased the amount of credits that you can't overlap with. They added a few other credits, mainly the R&D. If you have R&D, that's something you have to be wary about. If you're claiming that at the end of the year, and then you were taking ERC, there's some interplay with that where you need to take out those wages. And so now that I've kind of touched on, what the qualified wages are, what's the max benefit you can get with all this. I'm going to kind of talk about how you essentially claim the credit. Once you figure out the calculation, you do all this work to get to a couple different numbers of how much you're going to get per quarter. You have to file these through your payroll returns. This is a federal credit we're filing through our 941s, our federal 941s. So there is going to be a 941X that needs to be filed for each quarter. in which you're taking wages that and taking the employee retention credit. So you're going to be filing those, and in order to do that, you're going to need information from your originally filed 941. You're going to need all your wage reports that go into that, the original filing, because that's how you're going to make your calculation. You're going to base it off of like wage reports. That's how you're going to figure out what your qualified wages are for the calculation. And so ultimately it's going to be reported on the 941X. And then there's some additional worksheets that you fill out too to basically calculate out a refundable and non-refundable portion of the credit. It's all refundable at this point in time, but there is some breakout that you need to do to basically separate the employer piece of certain taxes, either Social Security taxes or Medicare taxes. One thing to note with these is that you are making these filings, these paper filings of these amended returns, or we are in many cases, and the IRS is very backed up right now. And to see the money in 9 months to a year is pretty typical. And that wait time has been going up and up, and the IRS has been talking about doing things to reduce that wait time, but nothing really has been done yet. So I wouldn't worry once these are filed that if you haven't received it in 2, 3, 4, 5 months, even 6 months, because it's probably going to take a lot longer than that. So that's just something to be mindful of as well. There's a couple other things to consider as I'm kind of wrapping up here so we can get some questions. The employee retention credit, it's not includable as income, just like the PPP, but it is subject to disallowance rules, at least for federal purposes and a lot of state purposes. So basically, it's a taxable credit. The IRS is saying it's not considered gross income, but it is a reduction of your payroll expenses. So it will require, and not only do they say that, but they say it needs to be a reduction of your payroll in the year where you are claiming those wages for the employee retention credit. So if you're claiming it for 2021 or even 2020, some amended filings of your income tax returns are going to be required after the filings are done. So I mean, the net benefit is always greater than all the cost and kind of time that it takes to file these, but at the end of the day, you'll get a lot of money, and I think you'll be happy. So I touched on those. The IRS did extend the audit period from 3 years to 5 years for these returns. So that is just something to keep in mind. It's good to keep important records of how you calculated the credit, or and what you used to qualify, what period of time you're using as well. And so you'll need to just keep those records for because they did extend that audit period. So you may be audited on this 4.5 years down the road after your filing. So so it's important to keep that in mind. And then one other thing that I just kind of added was if you do, most of the time, we can file your amended 941s for you, and it's not really a problem. But the only time where it could be a problem is if you have a PEO company, and if that is the case, you will need to reach out to them because they will need to file. We've seen in the past where certain people are just making the filings individually and not through their PEO if they have one, and it causes problems. And so to avoid all that, if you do have a PEO, you need to reach out to them for the actual filings of it. But we can always help you do the calculation of the credit. It's just the ultimate filings will have to go through the PEO. So please keep that in mind as well. I do want to spend 30 seconds here just talking about some success stories or some areas where we kind of found some people some more money. Private schools, most private schools are really an area of most of them qualify at least for the period in 2020. I believe the mandates that kind of Mark touched on a little bit earlier were basically all private schools were pretty much shut down through June. So that's a a good 3-month period where you know, you could get the credit, if not more, depending on the regulations and mandates in, you know, whether that be municipal or statewide. It all depends, but most private schools can get the credit within 630. So we've had a big push to help a lot of private schools get a lot of money, and you know, it's been great working with a lot of private schools to help them get as much as we can. And so that was a success story that I kind of wanted to share. And then also I did touch on the alternative quarter elections, but there has been some clients where on initial looks, you know, we did not think that they would qualify, but one of the things with the alternative quarter election is when you're using the prior period's gross receipts to qualify you for the current period, that starts in the first quarter of 2021. So you can look back at your fourth quarter of 2020 and compare it to 2019. And instead of looking for the 50% drop, you're only looking for a 20% drop, like the qualifications are in 21, then you can qualify for 2021, which is where you'll get a lot more credit. So that has been awesome for you know, a lot of our clients where, you know, fourth quarter or in 2020 they didn't do it, or in every quarter they did relatively well, or, you know, not within the 50% limit of 2020, but when you're looking at the fourth quarter, you'd only need to look at a 20% drop. So so that has been great when you can really just kind of dive in deep and help somebody qualify even when at initial first thought they didn't think so. And so that's really all we had for today. We have a couple minutes here for questions.
Yeah, Dan, we did get one question in the chat. So somebody wrote, so if we qualify for the credit in first quarter and second quarter of 2021, are you also able to take the credit for third quarter of 21, even if sales went back up in that quarter?
Yeah, so let's say in your second quarter of 2021, you know, you qualify based off of your gross receipts and you're not already using the alternative quarter method, then yes, you would be able to qualify in the third quarter of 21. Because so if your second quarter gross receipts of 21 were less than 20% of or 20% down from the second quarter in 2019, then yeah, you could take the third quarter and elect to use the alternative quarter method. So you're just saying, even though we went up in third quarter 21, we're using the prior quarter's receipts to qualify us for the current quarter. So yes, essentially yes.
Thank you.
Is there any? I'm trying to look through the chat.
Yeah, that was the only question. Yeah, if anybody else has a question, you want to put it in the chat real quick before we go. And just basically want to thank everybody for jumping on the webinar today. And yeah, feel free to reach out to either myself or to Dan, and we can you know, go over some more questions with you, or kind of tell you more about how working with us could work. You know, basically what it would be, we would calculate the credit for you, file the amended payroll tax returns, and then help you amend your, you know, company and potentially personal tax returns if you're an S corporation or a partnership where your income flows down to you at the personal level. But we can talk through all of that, and hopefully everybody learned something today, and hopefully we can help you get some more money back from ERC.
Yeah, I want to thank everybody as well. You know, there's a lot of money out there with this credit still, and you know, we like to talk about it. And like Mark said, you know, we can really kind of step in wherever you'd need us to help, and we could, you know, we could take care of a lot of this credit throughout the entire process. So please feel free to reach out to us, and we also have a general ERC team email as well. That we'll send out with the slides when we send them out, that you could reach out to as well. And you know, if you think you might qualify, we could set up a phone call and discuss.
All right. Well, thanks everybody. Have a great day.